There is something seriously wrong in the banking sector. While everybody is distracted by the AI bubble, there is a crisis brewing in the banking sector. Whenever there has been a banking crisis in the history of the United States, it always ended up crushing the entire economy. And this crisis could potentially be much bigger than the crisis of 2008. If you think that I'm exaggerating, let me show you exactly what is happening. But before we get into that, we have to understand the basics of how banks works. A bank is a financial institution that takes money from depositors such as you and then loans that money to anyone else who needs that money in form of mortgages, auto loans, credit card loans. But usually, whenever you deposit your money, that money doesn't instantly go to the depositors because the bank needs clients to loan that money, which is why sitting on tens of billions of dollars is extremely unprofitable. Imagine you're a bank and you now got so much money from depositors. Every single day that you're sitting on that money, you're not making money, but you promise to pay interest to your clients, which is why usually the banks take that money and invest it in the bond market by buying government bonds. Government bonds provide you with some kind of a stable return, and US Treasury bills are considered safe havens, the safest investments possible, and you can easily turn them into cash whenever you need them. So if suddenly you have a lot of clients, you can turn your Treasury bills into real cash and provide loans to these clients. The US bond market is so huge that hundreds of billions of dollars of transactions are taking place every single day. So you can easily sell your treasuries to asset managers, to other banks, or even the Federal Reserve. Which is why if you have a lot of bonds, people would consider those government bonds equivalent to cash. Even though that these treasury bills are as good as cash, at the end of the day, they're assets, and their prices fluctuate in the market based on demand and supply. If there is a lot of demand for these government bonds, suddenly the price of bonds increase. If there is very few demand and there is a lot of supply for these government bonds, suddenly the price of these government bonds are going to tank and they will worth a lot less. If you have $1,000 government bond that pays 2% in interest rates, and suddenly the new government bonds pays 5% in interest rate, now the demand for older government bonds that pay just 2% in interest rate suddenly fallen. So the price of these government bonds are going to fall. You no longer can sell it for $1,000, even though that you can get $1,000 at the end of the day, since the new government bonds are going to pay you a much higher interest rates. Understanding that dynamic in the market is extremely important since banks are sitting on trillions of dollars of government bonds if you take the entire industry. Usually even smaller banks have billions of dollars of these government bonds. Now here is the real problem. What happens if the demand for US treasuries fall? Suddenly bond prices are going to fall dramatically, which means that on paper these banks are going to make a lot of losses. Imagine you are a bank and you have $100 billion worth of government bonds, and suddenly you need cash. However, because there is very little demand for these government bonds, on paper their prices have fallen. You did not make real losses unless you sell these investments, then you are going to realize those losses. For now, these losses are just on papers. If you wait enough for the market to correct itself, maybe the prices of these government bonds are going to jump back and they will worth as much as they did in the past. Maybe they will worth a lot more. But because on paper, theoretically, if you sell your government bonds today, you won't be able to pay off your depositors, that is going to create a panic in the market. If I keep my money in your bank and on paper, if I see that theoretically there is a chance that you won't be able to pay me back, I will instantly run to the bank and will withdraw all of my money. I would rather deposit it in another bank because I don't want to take that kind of a risk. What if suddenly I won't be able to withdraw all of my money? Which is why that often creates a panic in the market and leads to a bank run. When everybody suddenly rushes to the banks to withdraw their money, suddenly the bank will run out of money and it will declare bankruptcy. And that happened multiple times in the US history. The most recent famous example is the Silicon Valley Bank. During 2020 and 2021, when the economy was filled with cash, a lot of companies, especially startups, were left with billions of dollars of cash, and they had to deposit that money somewhere. So a lot of money went into Silicon Valley Bank. Between 2020 and 2021, $189 billion was deposited in Silicon Valley Bank. Silicon Valley Bank was sitting on so much investments, and because inflation was running very high, SVB had to do something. It had to invest that money somewhere. So they invested pretty much most of that money in the safest investments possible, the US Treasury bills. But back in the days, or back at the end of 2021, the interest rates were so low, and US Treasuries would pay around 1 to 2% in interest rates. So most of that money went into the government bonds. Suddenly, in 2022, the Federal Reserve started to hike interest rates. So the new government bonds suddenly had a much higher interest rates. Between January 2022 to August 2022, interest rates were risen from about 0.5% to as high as 5.5%. Why would you buy a government bond that pays you a 2% in interest rates when you can buy a new government bond that pays you 5.5% interest rates? Well, Silicon Valley Bank did not make any real losses because it was not intending to sell those treasuries in the first place. On paper, the prices of these government bonds suddenly tank. So they made losses just on paper. These losses are unrealized. These losses are not real. Investors on the other side who looked at the Silicon Valley Bank and realized that, wait a second, theoretically, Silicon Valley Bank cannot pay off every single depositor, which is why I will rush to the Silicon Valley Bank and withdraw all of my money. That created a panic in the market. So investors, one after another, rushed into the bank, withdraw all of their money. In a single day, people withdrew like $42 billion out of the bank, and the bank was running out of money. It could not pay off its depositors, which is why it declared bankruptcy, and the government took over the bank. While treasury bills are considered the safest investments because they pay you interest and they're backed by the US government and you can instantly turn them into cash, their prices fluctuate in the market, and you have to take that into consideration. And here's what happened in 2022. When the Federal Reserve hiked the interest rates, suddenly the rates on the new government bonds suddenly jumped to about 5.5%. These are the yields for 2-year government bonds. Their yields have risen to 5%. The yields on 10-year government bonds have risen to as high as 5.5%. Imagine you have the safest investment possible that pays you 5.5% in real cash. What do you think investors have done in 2022? Everybody who had extra money suddenly started investing in the US Treasury bills. That is the reason why Warren Buffett invested all of the Berkshire Hathaway's cash into US Treasury bills that pays 5.5% in interest. That is why Warren Buffett is sitting on $350 billion of US Treasury bills. That investment is very safe and it pays you cash of 5.5%. You won't be able to find that kind of investment anywhere else. In fact, that encouraged a lot of other commercial banks, mutual funds, investment funds to purchase a lot of US government bonds. In fact, foreign investors, foreign governments, foreign pension funds looked at this and they're like, wait a second, this sounds like a fantastic investment, so let's invest into the United States. Canada suddenly, starting from 2022, started massively investing in the US Treasury bills. And that's not just Canada, that was the rest of the world because this was one of the greatest investments possible. Yes, inflation in 2022 rose dramatically in the United States. However, because the Fed hiked interest rates, everybody knew that the inflation is going to go down to about 2 to 3%. Well, if you buy a 10-year US Treasury bills that pays you 5.5% in interest rate, you could be receiving that much cash over the next 10 years. It was literally one of the best investments possible. So the demand for US Treasury bills dramatically rose to all-time high. On the other side, the cost of servicing the debt for the US government also rose dramatically, which is why in 2022 and 2023, the US government paid almost $1 trillion in interest payments. Now, here's the problem with the banking sector. Inflation hasn't been solved yet, and inflation is still around 3%. Even the latest data suggests that core inflation or core CPI is about 3%. On the other side, the Fed is lowering interest rates. So interest rates have been already lowered from 5.5% to as low as 4%. And recent data indicates that the Fed is willing to continue lowering interest rates from 4% to as low as 3.25%. When the Fed lowers interest rates, the yields on government bonds also go down because the biggest buyer of US government bonds in the public market is the Federal Reserve. The Federal Reserve will continue buying US treasuries. The yields on the US treasuries will fall down as low as the interest rates that are set by the Federal Reserve, which means that when you have yields on government bonds at 3% and inflation at 3%, suddenly it does not seem like a great investment to invest in US Treasury bills. Suddenly buying US government bonds is not as profitable as it was back in 2022, 2023, and 2024, or even in 2025. So if you are sitting on hundreds of billions of dollars of US Treasury bills as a mutual fund, as a bank, or any other financial institution, you're like, I would like to take that money out of the US Treasury bills and invest it somewhere where I will have a real return. Because in this scenario, inflation is 3% and I'm earning 3%. So essentially my money isn't actually growing. I'm not making real money. I'm simply making as much as the inflation rate. So Warren Buffett most likely is going to sell all of his government bonds, which worth $350 billion. Commercial banks will less likely be buying those US Treasury bills. Foreign investors who purchased so much US Treasury bills back in 2022, 2023, and 2024 will start also massively selling off their Treasury bills. So if banks are going to find it much difficult to turn their Treasury bills into real cash, that's when banks will experience a liquidity problem. They won't be able to sell their Treasury bills in the market to pay off their depositors, and they will be forced to lower their prices or to sell these government bonds at a lower prices to turn them into cash to avoid a bank failure. And if they do that, on paper they will have unrealized losses, and that will be pretty much the same fate as the fate of Silicon Valley Bank. Now that is slightly different from the fate of the Silicon Valley Bank, because the reason that Silicon Valley Bank failed is because bond prices and bond yields have an inverse relationship. And that means that if interest rates has risen, then bond prices are going to fall. If interest rates have fallen, then bond prices are going to rise. And that's because the new bonds are going to pay either a higher yield or a lower yield, which is going to impact the previous government bonds. But in this case, because the US government debt has grown so much and there's so many treasury bills in the market and inflation isn't fixed yet, and we're artificially lowering down the interest rates to about 3%, which is as much as the inflation rate, it will simply be unprofitable to hold US treasury bills, which is why it could actually break the system that we had since 1944, where bond prices and bond yields have an inverse relationship. And that is the risk that most banks in the US are facing right now, especially the small banks that are more reliant on the treasury bills. In this case, banks have two options. On one side, they can simply declare a bank failure because they simply won't be able to pay off their depositors. On the other side, which is the most likely scenario that is going to happen, is the Federal Reserve will simply buy their treasury bills and will create artificial demand for these treasury bills to be able to avoid bank failures. But that means that every time the Federal Reserve is buying the treasury bills, it means that the Federal Reserve is literally creating money, which is going to lead to a much higher inflation, which means that inflation won't be fixed anytime soon. All those projections that inflation will go down to as low as 2% by the end of 2026 are simply projections, because if this is going to happen, then the Fed will be forced to intervene and create much more money, creating a much higher inflation rate. It seems like we have reached to a position where every single problem in the economy is being solved by the Fed just printing money and bailing out. So we have a debt problem, then the government or the Federal Reserve will simply artificially keep buying US Treasury bills to help the government to avoid a default. And whenever the Fed is going to do that, that means printing more money. If banks are finding it difficult to turn their treasury bills into cash, then the Fed intervenes, prints money, and buys those treasury bills. It seems like we are living in this inflationary environment where we have actually reached to a point where we fix every single problem by printing money. And in these situations, it's very, very important to be financially literate, to know where to invest, how to invest, and make sure that you get out of this situation much wealthier, because the vast majority of people are going to lose. The vast majority of people will see prices rise dramatically while their paycheck stays the same, which means that every single year, the average person is simply getting poorer. So if you want to know how do you get rich or how do you profit from crises, especially from market crashes, then check out the first link in the description of this video. That's it for today, guys. Thanks for watching, and I will see you in the next one.